Welcome, my friends, to the first episode of the Josh Scanlon or Heritage Wealth Planning YouTube channel, coming right at you from my basement. Look at this, the first one I've ever done in my basement. As you can see behind me, there's my pull-up bar. There's my light to get a little bit better light. There's the squat rack, and there's us doing some. That's 35 pounds. I think I forgot what I was doing this morning. Some presses, yeah, just straight presses. And there's my other bar. If you can see that. I was doing some deadlifts earlier. There's the dumbbell bars, and there's some dumbbells over there. Also behind there is my aquaponic or hydroponic. I think it's hydroponic plants and stuff like that, so I can grow vegetables inside. Yeah, everyone thinks hydroponics is for marijuana growing. No, it's not. Hydroponics is a wonderful way to grow food. Very water and friendly. I think aquaponics is where you have fish. Hydroponics is where you just grow the food by itself. Can't remember, but either one. I don't use a fish. It's a wonderful, wonderful idea, actually, for self-sufficiency. Aquaponics. You got fish on the bottom pooping, all kinds of nutrients that go up. Your food eats it. Man, talk about compost. What a wonderful thing. I actually use a lot for the grow lights, inside grow lights. Pretty easy to create a little PVC pipe. Use like a Walmart tote and just drill some holes in there. And, man, you can have a wonderful little hydroponic system right there. Lettuce. I had some... Probably not so good on tomatoes. You can do those little cherry ones, those tiny ones, but anything bigger than that. I tried blueberries and they were working okay, but not. They need the real sun. But hydroponics is wonderful. I'm a big fan of it. We grow a lot of stuff inside for sure. So, all right, well, that's not what I want to talk about here today. What I want to talk about is some of the stuff I've seen on Quora. And the reason I come down here as opposed to doing my normal screen sharing, because I want to incorporate my whiteboard here a little bit. Sometimes it's easier to explain things using a whiteboard, even though my handwriting is not great, but hopefully you can get a gist of what I'm saying. I do got my mic on here if you're wondering what that is. It's just plugged into my cell phone, and I think it works pretty well, actually. So hopefully the audio is good. It looks like the light is pretty good down here with that light that I have. All right, so let's go into this. I'm going to start going into some of these more as we go forward with these videos down here. And not the most formal, but whatever. Trying to get some education across, and I think this will be helpful to you. So the first thing it was a Quora. This was actually a YouTube video I was watching, and the lady was a pretty decent job. The lady, I forgot her name, and I podcasted about this today. But there's a huge, huge error. This one comment made on her channel, and I had to explain this because I was she should have corrected the guy in the comments. And look, I'm not whatever, but at the end of the day, she didn't. So I'm going to now, because if he or you or anyone follows this mentality, you are doomed financially. There's no other way around that. So let me tell you what I'm talking about. Let me get my trusty pen here. Oh, here it is. So basically what the lady was saying is you need more than $1 million to retire comfortably. And her argument was that if you had $1 million in today's realm, you're only getting 3% income, which is $30,000 a year. And I absolutely agree with that. If you have a 50-50 stock bond portfolio, the bonds are probably giving you 4. The yields on the stocks are giving you 2. Together, they're 3%. Now, the problem is can you see that? Stocks, bonds, the yields are 4. Dividend yield is 2 on stocks. You combine them, you get 3%. So 3% goes back here, and you're making 30,000 a year's income. That's absolutely 100% factual. It makes sense. That is not taking money from principal, by the way. And that was my issue with her thing. Is she's essentially saying we're not going to touch principal, and this is how you get $30,000 a year, but you're not going to get any more than that unless you go more risky. And I agree with that 100%, but why not touch principal? I don't get that, but whatever. So let me show you what the conundrum is here for the guy who commented, and a bunch of people agree with it because there's a bunch of likes in there, or at least thumbs up, I should say, to his comment. And we're going to take the same scenario. You got $1 million. And what this guy was saying, it averaged 11.5% a year since the beginning of the stock market. I'm not sure what that is. 1926 is typically the modern era. If it goes back to 1871, even before that, but really in terms of being able to, the numbers and research is 1926. 26 is kind of the modern era. So if you got so his argument is you got $1 million and it averages 11.5%. The stock market, and again, the stock market is what, the Dow, the S&P, the Wilshire 5000. I don't know, but let's just say the stock market. You're going to get $115,000 a year of income each and every year. So if you have 11.5% average rate of returns going back to the history of the stock market, your $1 million will give you $115,000 a year. You only need $100,000 to live on, which is what he was saying. You can take $100,000 out each and every year, which means you have $15,000 going back to principal. So now you got $1,015,000 growing at 11.5%, which means you can give yourself a little bit of a raise. I guess that'd be another, what, $1,500 or so. So now you get $101,500 the following year if you're going to average 11.5%. But here's the problem. Let me show you. So let me just clean this off here. Got my little whiteboard care. All right, we'll get that. I think I got that from Walmart for like $2. This whole setup right here costs like $10. I think this whiteboard might have been 20. Just need a couple of screws to screw that guy in the beams here. All right, it's a pretty good setup actually. All right, so now what we're going to show you though, let's say you retire $1 million, all right, in 1999, the end of 1999. The S&P 500 the following year was down 9%. All right, oops, just 9%. So basically, you are down $90,000. So you're at, what's that, $910,000 is what you were left with. Now, if you take $100,000 out, like the guy was saying, that is no longer a 10% withdrawal rate. In fact, let's get my trusty little calculator here. 100 divided by 910, our distribution rate is 10.9%. We're just going to say 11%. All right. So now you're down 11% is your distribution rate, where before it was only 10. Unfortunately, the following year, the market fell 22%. So now we're left with $810,000. And now, where the market was down 11% the following year, so now $810,000 minus 11%. Now we're at 720. 720. And you can see where this is going. So now we're at 720. And if we take 100,000 from 720, 100,000 divided by 720, which means we're taking a 14% distribution rate, and you're doomed. I mean, you're not going to make it throughout. You're not going to make it. You're not going to make it beyond the 10 years. It's just not going to happen. Which is why we have to nip these things called linear rates of return in the bud. Linear rates of return simply says, I have $1 million. I should be able to get 11.5% each and every year, each and every year, each and every year. The reality is, some years I get 22%, some years I get mega 40%, up and like that. That's the reality of the markets. This is not the reality. The linear is not. The ups and downs are. Just what happens is typically the ups more than offset the down. So we'll get a 40% up and only 30% down, a 20% up, an 8% down, or something like that. That's how the markets work. And so we have to nip in the bud immediately. Any idea, my friends, that you're going to get an 11, 10, 8% standard rate of return on a regular basis, it's just not going to happen. You're going to, in fact, Vanguard did a study, and I keep talking about this. I've got to get that study. But they said at the end of the day, the markets only give you like between 8 and 12% rate of return, which is basically the average. But say 10% is the average. The markets only give you between 8 and 12, like 5% of the time. The other times it's way up or it's way down. That's a wonderful study. I got to show you that. So that is called the sequence of return risk. Now, if you retired in 1982, you still might think you can take 10% a year off. Well, I haven't run the numbers because you shouldn't ever assume you can take 10% a year off. But this is where we get the 4% rule. take $1 million, recognizing the volatility of the markets. This actually should kind of be like that is what it should be. So you can see like that. That's the average trend right there going up. So it's kind of volatile, 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 volatile. But the threshold has historically gone to the, what's that, the northeast. But 4% will give you $40,000 a year of distributions you could take without ever running out of money is a historical concept of that. But remember, the 4% rule assumes you got basically a 60-40 portfolio, a moderately aggressive portfolio, and you kept at it for the entirety of your retirement. You didn't bounce back and forth in stocks and bonds. You didn't go CDs. You just said, at the end of the day, I'm retiring in 1999. I'm putting 60% of my portfolio in stocks, 40% of my portfolio in bonds, and come hell or high water, I'm keeping that portfolio just like that. If I go heavy to bonds because I'm worried about the market, the 4% rule doesn't apply. It says you stay the course throughout your 30 to 35 years of retirement. You do not change tactic. Now you got to rebalance, yes, but you don't change tactic where you're in 2008, you're like, Obama, or 2016, Trump. You got to stay in there. So that was one thing about the sequence of return risks that I think you just got to watch out. And this is where the 4% rule has come to be for financial planning vernacular, pretty good rule of thumb to start with. Now, there are some people who say the 4% rule, given the rates of interest now, should be 3.2% because the long bonds, relative to what they are today, relative to what they are in the past, are about half the interest rates that you're getting. Well, that may or may not be true. The dividend yields are also way low as well. At the end of the day, that may or may not be true. I tend to kind of subscribe to the idea that maybe 3.5 is probably more along the lines of the 4% rule, given the interest rates gone down and the yields have gone down as well. The only thing that I challenge is that at the end of the day, that is a safe withdrawal rate, which means that's kind of like the minimum you can take out without running out of money. The average is about 5.5 to 6, I think, is what some of the folks I follow say. So if you're willing to take on more risk, you could take out, say, 5.5% on that $1 million. There is more risk of running out of money. Well, guess what? The markets go down, tighten up your belt, for heaven's sake. This is one of the things that drive me crazy. The markets are down 15, 20%. Well, you don't keep spending. You say, markets took a breather. I need to take a breather. Maybe I won't take that trip to Cancun. Maybe I won't buy that new Harley, whatever it is going to be. You'll just tighten your belt. A guy from the Journal of Financial Planning, man, I can't remember his name, did a pretty good analysis on safe withdrawal rates. He said, look, if the markets go down 10% or more, and I'm paraphrasing him, it's been a few years since I read the article, just tighten your belt a little bit so you're giving yourself no pay raise for inflation. So if you're spending $100,000 a year before, the markets go down 10% or more, keep spending $100,000 a year. Don't increase your spending with inflation, at 3% or whatever, and you'll be fine. So lots of different strategies there. The whole issue is every year, go to your financial planner, Josh, or go to your computer and say, I got $100,000 today. I need $4,000 next year. What's my likelihood of survival? Do not just long-term plan today and put that forward for many, many years to come. It's crazy. Long-term plan today, your next long-term plan is next year. Your next long-term plan is the year after that. It's year to year to year to year. You got to take into consideration tax code. You got to take into consideration investments so you can rebalance stuff. You got to take into consideration any kind of life activity that may have happened. I hate to say it, but maybe you got hurt. Maybe someone died. Maybe inherited money. Maybe the tax laws have changed like now they have the standard deductions really, really being favorable now. You've got to get in front of your financial planner. All right, part 2 of this tutorial, my whiteboard tutorial. A guy at Quora, this is what I want to say. He said, what's the difference between interest rates and total return? Another one, again, pet peeve is too strong. But the same argument was made with the same lady on YouTube. Some of the people are saying, you're only saying 3% a year. You can get 8% a year. And I'm like, man, you guys don't know the difference between total return and interest. And I want to share with you what that is right now. So remember, a bond, we'll say it issues at $100,000. And say the interest rate is 6%. That means each and every year you're going to get $6,000 of interest. $6,000 each and every year. That won't change. The interest will pay year 1, 2, 3, 4, until the bond matures or the company goes bankrupt. One of those two things. Or if they have what's called a call on there and they can refinance with you, essentially what a call option is. The bond issuer can say, we're paying you 6%. We want to refinance that 4%. They can do, if they issued the bond with a call option, they can call that back for you. So the only way this won't happen is one of three things. The bond matures, the bond issuer goes bankrupt, or three, they have a call option. They could call the bond out from you and reissue it to you at a lower interest rate. And then, now, if they have that option, they will have to pay you the par value, which is the amount at maturity. So that happens quite a bit. I don't know if it happens that much anymore, given the rates are so low, and most likely the rates will go up as opposed to go down. But it's something to look at. You always want to see if you're buying an individual bond, does it have a call option? Nothing inherently wrong with that. But anyway, so that's how a bond works. 6% a year. You're going to get $6,000 on $100,000. Now, what other people think that they confuse though is they say, well, I bought the bond for $100,000. I'm getting my 6% a year, but now the bond, because other interest rates have gone down. So what happens is if I can buy a bond that pays 6% or a bond that pays 5%, what's more valuable? Well, these issuers are going to issue a bond for $100,000 at 5%. But the exact same issuer also has bonds they issued previously that pay 6%. So the issuer, GE, nothing is different with their company. Everything, cash flow, CEO, everything is the same. Except one bond pays $6,000 a year in interest, one bond pays $5,000 a year in interest. This is a new bond that was issued. This was issued last year. So the new bond that was issued is only paying 5%. What does that make for the older bond? So if someone needs more interest, 5% doesn't cut it for them. They need more interest. So they're going to buy the 6% bond as opposed to the 5% bond. 5% bond costs $100,000. The 6% bond costed in the history, plural history, before $100,000 as well. But if I want to sell that bond, am I going to charge $100,000 when the same bond paying 5% only costs $100,000? No, I'm going to charge more. Let's just say 105. There's actually calculations. You can see exactly what I'd pay for that bond or I could sell that bond for. But let's just say I sell it at 105. So someone says, I am willing to pay you a premium, $5,000 more than the par value. The par value is what is issued, when it's issued at, and what it will mature at, $100,000. I'm willing to pay you $5,000 more for that bond because I'm getting $6,000 a year than I would if I was only getting a $5,000 a year bond. That makes sense? Because it's paying more in interest, I'm willing to pay more for the bond, even though I know for a fact when this puppy matures, I'm only going to get $100,000. So I'm going to take it on the chin to lose that $5,000 because at maturity, I'm only getting $100,000 back. However, I know for a fact, according to my calculations, that this will pay me more than this will. So I'm willing to lose $5,000 in principal in order to gain an extra $1,000 in interest for the next 10, 15 years. That's how bond interest rates change. Not interest rates, prices change all the time. So essentially what you're saying is, I want more interest. I'm willing to take a loss in the future at maturity of $5,000. But in the interim, I'm going to get an extra $1,000 each and every year. Everything about the company, the issuer is the same. Credit rating, CEO, cash flow, everything is the same. So if I, in 10 years out, and I say I will get $6,000 a year for the next 10 years, and then I'll lose $5,000 of a capital, which means I'm getting $60,000, $6,000 a year for 10 years. I made $60,000 of interest. But I will then lose $5,000 because I bought it at 105 and I'm only going to get $100,000 back at maturity. That means I'm netting $55,000. On the other hand, if I bought a $100,000 bond today, I'm only getting 5% and that sucker matures in 10 years. I'm not losing anything on the principal because I paid $100,000. It'll mature at $100,000, but I'm only getting $5,000 a year for the next 10 years. The better deal is here. Over 10 years, I'll net $55,000. Over 10 years, I'll net $50,000, even though I paid a higher price for that bond, even though I will lose $5,000 between when the bond matures. Critical to understand that, because that is how interest works, because I'm getting 6% each and every year. Now, what happens when it comes to total return? All right, and this is where I think a lot of people get confused on bonds. They'll say, I can make more than the interest rate because I can turn around and sell that bond that I bought $100,000 for. I can sell it for $105,000, which means I have a $5,000 capital gain on top of how many years I held that interest for, 6%. So I'm basically saying I got a 5% capital gain plus the 6% I received in a year. So at the end of the day, let's just say I held that bond for a year. I get $5,000 capital gain plus $6,000 of interest. I got $11,000 total on that $100,000 investment, which means I have 11% rate of return. That's total return. That's total return. Interest was just the $6,000 I was getting on the bond. Because the interest rates changed, this number changes. If the interest rates went up, by the way, that would go down. But either way, because the rates have changed, I may be able to sell the bond for a profit and had pocketed this 6% at the same time, which would give me a significant boost in total return relative to the yield, the interest I was getting. So again, I was only getting $6,000 a year in interest, but because I was able to sell it for a premium at 105 over 100, you add that $5,000 of premium plus the $6,000 of interest I made 11%. That's total return. Now, a lot of people say, oh, bonds will pay me 11% interest. No, they will not. The only reason you got 11% total return is because the interest rates changed. What was out there today became more valuable because over the next year, the interest rates changed, which meant the price of the bond that I was getting 6% on jumped to 105. You cannot bank on that as a total return. You can't. Because for this to happen again, the interest rates got to keep changing. They got to keep changing. But when they go down, they can also change to go up. So as quickly as that 105 was there and you were able to pocket that $5,000, what if the economy tanked and the Fed started saying we got to lower? What if the inflation started kicking in and the Fed started saying we got to increase interest rates? When you increase interest rates, that 105 goes to 95. And so now, let me get my right here. So now, let's just use that as an example. That 105 at 6% now goes to 95 because the Fed is raising rates in order to restrain the economy. They're worried about inflation. That's all silly talk. It's macroeconomics, Phillips curve stuff that they taught in 1950s. For some reason, we're still buying into it. But at the end of the day, now we're at $95,000. Now I did make $6,000 in interest, but I lost $5,000 in principal. Remember, I bought this at $100,000. So I made $6,000 in interest, but I lost $5,000 in principal. So now I'm only up $1,000. So my total return in that case is all 1%. 1%. I made $6,000 of interest. You probably should actually say that's $100,000, to be honest with you, because that's what we bought it at. We bought the bond at 100, not 105, because the interest rates went up. Now this bond becomes less valuable market-wise. So now it went from 100,000 to 95,000, which is a capital loss of $5,000. I was still able to make $6,000 a year in interest. $6,000 minus $5,000 loss means my total return that year is 1% because I made $1,000 net on that bond that I had. That's how total return can really, really change things and make people see things that don't exist. Because at the end of the day, all that can happen in the context of you just sitting on your bond not doing anything. And if you just sit on your bond, your $100,000 bond at 6%, you're getting $6,000 a year, year in, year out. It doesn't matter what happens to the price. It doesn't matter what happens to interest rates. It just matters that the company doesn't go bankrupt. The bond hasn't matured, and they don't have a call option on that. If that's the case, your interest is only 6%, or good asset, whatever it is. Your total return on any given year could be up 11%, could be down. It could be whatever the price is of the bond. But if you don't sell the bond, it's kind of like your house. You don't care what the stupid price is because you're allowing the bond to go back and forth. And then when you wake up 20 years from now, you're going to get this $100,000 back. And so your total return was 6%, $6,000 a year. It's literally that simple. Yeah, not your total return, your interest return was $6,000 a year, each and every year. It could not be any simpler. So let me just share something with you. A lot of people get confused. They say the bond market returned 8%. In fact, the USA had a fund, the income fund that was issued, I think, in 1972, and it averaged 8% a year historically. Maybe it's probably 7% now, whatever it is. And a lot of people say, oh man, that's a great fund. I want to get a bond, a safe fund, and get 7% a year. That sounds good. And I always say, you're not going to get 7% a year. What? I say, because the bond that was total return. It was issued at a time when interest rates are going down and down and down. I mean, they went from 1974 to 1982. They were going up because Jimmy Carter dealing with inflation and whatnot. But from 82 to basically today, from 82 to 2018, interest rates have just skydived, or I guess dropped like a brick in water. And as interest rates drop like a brick in water, the prices of the bonds that are in that portfolio go up and up and up. That's not total return. I mean, that's total return. That's not the return you're going to get from today going forward. From today going forward, the only return you're going to get is whatever the coupon is 6%. You cannot put your hat on thinking you're going to average 8% a year like it did from 1974 until today. You can't, because there's no way a bond is going to give you 8% a year. It's just not going to happen. The way a bond is priced is that is going to be your return right there. On any given year, it might be up, it might be down. But over the context of holding a bond for 10 or 15 years, you're not going to get hardly anything different than the rate, the coupon. It's called a coupon, the interest rate essentially. Interest rate and coupon are the same thing. You are not going to get anything different than that. I just cannot stress how important that is. And I know it's kind of confusing. At the end of the day, how do you look at bond returns going forward? What are they paying today when you buy them? Oh, they're paying 4%. That's what you're going to get. That's what you're going to get. Oh, but if I sell the bonds because the bonds have, the interest rates have gone up, have gone down, now the price of those bonds are higher, I might be able to get 4% plus a premium, like I said, the $5,000. Okay, but what are you going to do when you reinvest that money? You got to put it someplace, and now you got to reinvest it in a lower interest rate bond, because the only reason the price of your bond went up is because the interest rates went down. So you sell the bond, you're going to have to reinvest it in another bond. I mean, you can reinvest in anything you want, but if you're going to reinvest it in another bond, well, you're reinvesting in a bond that's gone down in interest. So you were getting 5, now you're getting 3. Yeah, you did sell for a premium, but you still got to reinvest that $100,000 into something else, and that something else is going to be paying a whole heck of a lot less, because the rates have gone down than what that 5% bond that you held, that you sold for a quote-unquote profit. It's just basic mathematics, my friends. What's paying today is what you're going to get for your total return if you stay in the bond market. Now, again, if you were to get that 11% like we talked about before and say, I don't want anything to do with the bond market anymore, well, that's different. Now you can invest in stocks, real estate, you pay off debt, I don't know. But at the end of the day, as I sit here and make projections for clients today, and we're looking at bonds, we're saying the average, let's see, the 10-year treasury, I guess on my phone, 10-year treasury is about 2.8. I know for a fact, if you buy a 10-year treasury today, we have to estimate you're going to get 2.8% over the next 10 years. Why? Because that's what it's paying. It's paying 2.8. If you sell it at a premium because interest rates have gone down, well, you might have made a quick total return different than 2.8, but you still got to use that premium made. You got to invest it someplace. And if you were able to sell it for a premium relative to the 2.8 you're getting today, that means the interest rates on that same 10-year treasury will only be 2.5 or 2 or whatever it is. So at the end of the day, it's a wash. I mean, it's all mathematical stuff when it comes to the bond market, my friends. The only thing that's not mathematical is if the bond issuer is going to go bankrupt. And that's where government debt actually has a authority, because it won't go bankrupt. It can't. I mean, theoretically it could, but they will pay you your interest by inflating the currency, or just paying you, or taking from taxpayers, whatever. At the end of the day, they're going to pay you your premium, your principal, the par value, again, is what it's called. So that's how that works. So just remember, the bond interest you're getting today is what you're going to get until the bond matures. You aren't getting 11, you aren't getting 2, you're getting 2.8 if it's a 10-year treasury. That's just all there is to it. You may be able to sell it for a premium because interest rates have gone down. Conversely, you may sell it for a loss because interest rates have gone up. It doesn't matter. At the end of the day, when you sell it and you reposition that asset, you have to reposition it either in a higher interest product at that point or a lower interest product at that point, and that will be reflected in the price you sell it for. It is not science here. It's just pure basic algebra, essentially. I'm getting 2.8. If I sell it for a premium, I have to reinvest that money in something else that's only paying 2.5. It's a wash. I'm getting 2.8. If I sell it for a loss, I'm going to reinvest it in something that's paying 3.5. It's a wash. It doesn't matter. I know for a fact the bond I have today is paying 2.8 is what I will get in terms of a yield over the next 10 years if it's a 10-year bond. All right. I'll stop that here. It's 30 minutes up. Hope this has been helpful. Hope you like my little setup here. Give me a thumbs up as always, because I actually kind of like getting on the board here. Hope you can read this stuff. Yeah, my handwriting's not the best, but as I explain it, I think it, well, we'll see, hopefully. So give me some comments on how this works for you. Questions, comments, concerns, put them in there. As don't forget to subscribe. Always subscribe. I need subscribers for sure. It helps me get Google and YouTube to see my content and share it with other people. Don't forget to hit the notification little bell there as well. Go to heritagewealthplanning.com, heritagewealthplanning.com. I just embedded that tax foundation calculator on taxes. It is awesome. I love it. So I'm debating if I want to put that on my homepage, my front page, or just a separate page. I'm not sure, but go to heritagewealthplanning.com. You'll see the embedded tax calculator. That's fantastic. And if you do a website too, man, put that thing on there. It's free. Taxfoundation.org, I guess. And just look for the 2018 TCGA tax calendar to put on your website as well. All right. See you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.